Great. Let's get started. Good day, everybody. My name's Emmett Kilduff. I'm one of the co-founders here at the Fortia Group and CEO of the firm. Welcome to today's webinar. It's our fourth quarterly webinar specific to e-commerce brand evaluations, the first of 2024. We're continually looking to improve these quarterly reports and webinars, and look forward to going through lots of interesting content with you today. The agenda, first of all, I'll kick off with just a brief update from what's going on at the Fortia Group. We'll then walk through the report. We have 7 sections to walk through with some great guest speakers, and we'll hopefully have time for audience Q&A. From a Q&A perspective, please submit any questions you have via the Q&A button on Zoom, not via the chat tab. And from a housekeeping perspective, the deck and the recording of this webinar will be circulated to all attendees. All recordings of webinars are available on our YouTube channel, so just please put in the Fortia Group into YouTube and you'll see all the previous work that we've done. Okay, so just on behalf of the Fortia Group, wanted to highlight a few things. One is we had a great conference here in New York last week, on Tuesday last week, specifically for acquirers. There are so many conferences for brands or merchants. It's hard for us to differentiate there. So we have focused last year and last week on creating the only conference globally dedicated to acquirers of e-commerce brands. We had over 100 folks turn up to the conference, including several online from around the world. Discussed everything that acquirers thinking about acquisitions, operational value creation, exiting brands and creating success stories. Why do we do it? We do it to show, to get close to buyers. The closer we are to buyers, the more we're able to help our companies, our entrepreneurs ultimately get the deals that they want. Later today, we are publishing the insights, the key takeaways from that conference. It's quite comprehensive, and so please take a look if that interests you. Acquire relationships. I encourage all the brands listening to this live or via the recording, just when you're selecting an investment bank to work with, please do choose a firm that really demonstrates they know who the buyers are. One of the ways we do that is conferences, but another simple way to demonstrate that we're close to all the acquirers is we have the only WhatsApp group for C-suites of acquirers. There's 123 C-suites of acquirers actively engaged in that community. For my sins, I'm the coordinator of that group. There's some great activity on it, industry updates, acquirers helping each other, and so on. So I have the mobile phone number of the people that matter from an acquisition perspective, which is key for any seller. Where does this all lead to? I'm ex-Morgan Stanley. Many of you have heard this before, but our big vision and mission by 2030 is to become the Morgan Stanley for lower middle market e-commerce. That's a massive North Star for us. We're working hard every day, and we'll be doing over the next 6 years to justify the right to have that tag. That's everything from the Fortia Group side. So let's dive into the report. So as you'll know, our approach to thinking about valuation is there's sort of 6 steps that lead to valuation. First of all, we need to look at global M&A activity. That has an impact on the valuation of e-commerce brands. And I'll take you through some interesting thoughts there. We then look at e-commerce trends, what's happening in the e-commerce space. And Moritz, who'll introduce himself in a moment, will take you through some really interesting data-driven insights there. Public market comparables. Private markets, are directly linked and correlated to public markets. So we have a speaker for the first time today from DrivePoint to take you through his thoughts on that. Then we get deeper into more relevant to the brand. So e-commerce M&A activity, what's happening? The funding landscape is tough for e-commerce. What does that mean for M&A? And we're delighted to have Lauren from Society Brands discuss some of the real deals that they've just completed. They're very active in the market at the moment. Then it's all about brand metrics. So what can you, the entrepreneur at a brand, what can you do? What levers can you pull to ultimately improve and help your valuation? Everything then in the end comes down to deal dynamics. How competitive is the auction process? How much capital is chasing brands, etc. And we'll give you some interesting insights that were discussed at the conference on that. Ultimately, we'll give you our view on where valuations are for both DTC-led brands and FBA-led brands. So We've got three great guest speakers today. Can I ask each of you to turn on your camera and introduce yourselves? Thank you.
Hi, Emmett, and hi, everyone. Thank you so much for making the time. My name is Moritz. I'm the CEO and founder of Grips Intelligence, and we create data on what sells online, both from the perspective of manufacturers as well as D2Cs and e-commerce retailers.
Hey everyone, my name is Austin Gardner-Smith. I'm a co-founder and CEO of a company called DrivePoint. We are a strategic finance platform for e-commerce and consumer brands. So essentially an FP&A platform for strictly focused on the consumer and retail industry, often working with these companies prior to an acquisition or a financing event.
Hi everybody, my name is Laurent Truc. I'm with Society Brands. I lead our business development team here. And apologies for taking this in the car. It's kind of last minute, but happy to be here and happy to walk through a couple of deals that we recently acquired.
Great. Thank you for squeezing us in, Laurent. Laurent's bringing his daughter to hospital, really squeezing us in, which is great. Okay, let's dive in. So first section, global M&A activity. I want to start by looking backwards a little bit. I have a data business separate to the Fortia group, and one of the data partners is a company called Trueflation. They are a really great measure of inflation. They have an index based on 30 data sources encompassing more than 13 million data points. It's free to get on their website, trueflation.com. What it shows is that inflation in the States has been declining quite significantly since October of 2023. That's clearly important. That was inflation was the measure that was difficult to control since COVID. What does that mean? That's one of the key drivers for market sentiment. Just on Monday night, the Dow Jones Industrial Average breached 38,000 for the first time. So the markets are buoyant. 57 stocks in the S&P hit record highs on Monday night. Now, for the fact fans, the quiz fans in the audience, you do need to sort of dig a little deeper to understand what's driving this market sentiment. And in fact, it's really a large part of it's down to two stocks. So 57% of the gain in the S&P 500 over the last 2 months has been down to just two stocks, Microsoft and chip maker NVIDIA. So if you took out those two stocks, the performance wouldn't be quite as good, but it's still broadly, all this helps market sentiment. So 2024, it's all about interest rates. That's the key driver. We had UBS give the keynote at our conference last week and talked about the economic and macro outlook. US rates today are 5.5%. People are expecting the first cut to be in Q2 2024. Hopefully it's earlier rather than later within that quarter. And we think that it can go from 4.6 in 2024, 3.6 in 2025 down to 2.9. That's what the market is thinking. If that happens, which touch wood it does, that will drive M&A activity. It gives cheaper access to capital, which will help acquirers, whether they're aggregators, private equity, and strategics, ultimately do more deals. So the future is bright for e-commerce M&A compared to 23 and 22. So where are we? Let's take a big step back with a great chart from Goldman Sachs. This is announced M&A volumes in trillions over the last 30 years. The light blue charts show where there's been a decline. So obviously 2021 was a significant year for deal volume, which fell in 2022, continued to fall in 2023, and hopefully we can have a dark blue line at the end of 2024. That's all down to interest rates. Certainly interest rates are a massive factor. Goldman's expects the majority of deal flow to be in technology, healthcare, and AI driven deals. So it mightn't necessarily be all in e-commerce, which is when interest rates come down, hopefully the consumer will get more confident and spend more, etc., and then we'll see consumer rebound over the coming years. Okay, so that's hopefully helpful to set the scene from a macro perspective. From an e-commerce trend perspective now, I'll invite Moritz to talk about his data-driven insights.
Thank you, Emmett. So we have been looking at how consumers have been spending online in the period of September to November, so the past holidays, versus the previous period, the year prior. And we found that overall e-commerce revenues have declined by about 1.7%, whereas we saw an overall price increase across the board of about 3%. So as you can see, basically what you're seeing here in the chart, at the on the x-axis, you see revenue year-over-year revenue changes. On the y-axis, you see price changes, and the size of the bubbles indicate how large the category is. What you see is that apparel, home and garden, and sporting goods all saw either flat or declining sales, whereas health and personal care products saw the biggest year-over-year declines. Smaller categories were the ones that have showed the most decent growth. So 3 of the categories that we saw posting the most growth were toys and games, food and beverages, and animal and pets. And in the next few slides, we're going to check out a few of these categories in particular. So now in the food and beverage industry, it posted growth more or less across the entire board. However, we can see that beverages and alcoholic beverages specifically were driving the bulk of the growth, while growth with revenues increasing more than 10% had a
Hi, Moritz, are you there? Moritz, we can't hear you. Can people hear me?
We can hear you. I mean, we lost Moritz.
Oh, okay. Let's give him 1 minute. Give us 1 minute to see if you can come back in. Thank you.
Emmett? And
Yes,
hello?
you're back. Great. Thank you,
I'm
Moritz.
so sorry. Yes, I'm so sorry. My Zoom just my Zoom just stopped.
No problem.
So apologies. Back to the food and beverage industry. So food products, we saw posted modest growth with only a few categories posting declines. And part of what we thought, was worth pointing out. We saw a lot of headlines about sort of how Ozempic were killing the snack industry. This was something that we couldn't find at all. Matter of fact, bakery, soda, and snack products all posted year-over-year growth. And finally, what we saw is that we saw the rate of price increases for the category come down significantly versus the previous year. Category being alcohol being one of the categories that saw a strong price increase. On the right side of the chart, you see some of the growing brands that posted strong growth, talking double digits, significantly more than some of the competitors. Moving on to the home and garden subcategory, it's next on the list. As you may recall, overall categories were flat year-over-year for this category as well, but there are subcategories that posted strong growth nonetheless. The trend that we're seeing is that consumers now have shifted the spending from inside the home to outside. Gardening, outdoor structures, wood stoves, and power equipment, basically everything that's sort of, battery powered, were among the fastest growing. And then for goods inside, the kitchen is getting a lot more love with spending on cookware and ranges, as well as items associated with home bar, like ice makers, wine fridges. Those saw the highest rate of growth. As we're seeing interest rates fall and the housing market maybe heat up again, we may again see higher growth in other categories that we didn't see a lot of growth in, such as decor, lighting, and appliances, which typically sort of, are big categories once people buy a new home. Finally, an interesting note is that sales of food and beverage carriers posted a decline. So this category includes brands like Yeti and Hydro Flask, which saw lower sales in recent months, despite strong brands like Stanley's posting strong growth. And then I'm ending my presentation today with a view into what happens in the electronics subcategory. As you called out, NVIDIA is one of the top brands, which we're also seeing on the consumer side. In the electronics category overall, though, we saw a sales decline year over year. Not all categories fell, though. In fact, computer sales were having turned a corner after pandemic investments led to decline in new equipment. And then we saw TV sales and GPS trackers and AirTags up slightly year over year. So despite the growth in computers, though, also other categories that saw a pandemic surge, like printers, components, and networking accessories have not returned to growth. So we see a quite significant shift in consumer behavior when we're looking at our data versus the data of the prior years. And then, meanwhile, video game consoles continue to fall as no major consoles released since, I think, 2022 or something. And since no updates are expected, we expect this to continue to post smaller growth. That sort of concludes our view. I want to say sort of, overall, we saw in the data smaller categories posting the biggest amount of growth, and then sort of some of the staples of the pandemic have not returned to growth, but we're expecting this to shift over the coming months.
Great. Thank you, as ever, for your insights, Moritz. If folks have questions for Moritz, again, please submit them via the Q&A button, and we'll get to that later on in the webinar. Super. Okay, so let's look at public market comparables, please. Over to you, Austin.
Awesome. Awesome. Thank you, Emmett. So just to give everyone a bit of context on what we're looking at here, several years ago, starting in late 2020, we started tracking a basket of public market securities that we thought roughly represented our customer base. So we were filtering for customers that were consumer brands selling at least a substantial portion of their revenue through a direct-to-consumer, primarily an e-commerce channel. So at this point, you can get a sense of the logos, and we'll go into some of the individual names in a moment here. But many of these brands are now selling across multiple channels, but all maintain a healthy direct-to-consumer component to the business. Again, primarily through e-commerce, although there's quite a bit of brick and mortar in this data set as we've exported it as well. So just something to keep in mind. And I think the market tends to be rewarding that as well. So if we flip to the next slide, basically the median metrics that we track as sort of being the key drivers of valuation. We look at obviously scale of revenue, the change or growth in that revenue, the percentage of revenue we estimate to be coming from the D2C channel. This is tracked through S1s and filings and 10Ks basically. Gross margin as reported by the companies, EBITDA margin, and then two measures of valuation. One is an EV to sales measure, which is helpful for companies that either have low or non-existent EBITDA, and then an EV to EBITDA measure. So just a quick snapshot of the latest readings here. I think we typically are using the median line as the best indicator of what we're seeing in the public market. So we can sort of isolate on that row, second from the bottom here. But across the board, looking at the margin profile has stayed relatively consistent for these brands. Interesting that the median gross revenue change was basically flat. So there certainly have been winners and losers in terms of revenue growth. Some brands are growing much faster, but that's mimicked basically if you look at the stock prices of these companies and the valuation changes. Much of the multiple compression that we saw happened in 2022, and 2023 was really a little bit of a bumpy but a relatively flat year overall. We have seen a tick up in the tail end of 2023 in most of these valuation metrics we can look at in a second. But on average, we're seeing a median valuation on a sales basis. And again, this is backward looking based on trailing 12-month sales. The median is just about 1 times sales at 1.1. And the average that we're seeing is about 1.5. On the very high end, we're seeing about 6 times being kind of the ceiling here. The market cap weighted average about 5. EV to EBITDA, seeing right now about a 7x on the median, 7.7x. Average is a bit higher than that. Again, there's some scale here that's being rewarded. And we can talk about that in a second as we go to the next slide. The key trends, I think, are captured here. And what's particularly interesting looking at the longitudinal data, again, I think we were coming off kind of a peak of exuberance in 2021, coming into 2022. And we saw a large degree of, these multiples roughly tracked in terms of their synchronization. What's kind of interesting about this chart in 2023 is the drift between EV to sales and EV to EBITDA. What that's indicative of to me is basically acquirers starting to just have a sharper eye on earnings and profitability being a key driver. I think gone are the days of brands being able to show up on the acquisition markets, certainly on the public markets, with negative EBITDA, unless there's a massive amount of scale. And I think in 2023, especially in the early part of 2023, that really hammered some of these companies from a valuation perspective. And we can talk about some of those names individually. But as the tail end of 2023 came to be, we're starting to see those two levers sort of trend a little bit more together. And we are seeing an uptick finally in some of these metrics around EV to sales. We've been hovering right around sub 10. We had a nice little blip up there, almost reaching that 10 handle again in Q4 of this year. And 7.7 was our last reading here. Emmett mentioned consumer sentiment changes. I think we had a great reading from the University of Michigan yesterday on the consumer sentiment. I think the highest sentiment rating since 2021, and a big change coming off of the low, which was in June of 2023 last year. So it feels to me like we are about to continue to see some uptick here, both in valuations and multiples. And we may also see some IPOs in the space. There's a number of, especially apparel brands, that are looking to come out and trade over the next 6 to 12 months. And so we should have some more data here on how the market is valuing these new entrants. If we go to the detailed table, looking at the variances and to sort of highlight some individual names and some themes here. I think one theme that's clear is that the market values scale. So the companies that are north of $1 billion of revenue and have corresponding market caps tend to be able to correspond to higher valuation. I think that stickiness, that durability, and that proof of scaled returns, I think gives investors confidence that there's going to be continued cash flows from these companies. So I'm looking at names like Lulu and Crocs sort of at the top of the heap that continue to be the best in class performers here. The other things that are interesting as far as when you look at the outliers on the EV to EBITDA multiple, I think Lululemon still represents kind of the gold standard for direct to consumer. By last reading, they're somewhere in the neighborhood of 50 or 55% e-commerce. So if you're an e-commerce brand that is in fashion and apparel or home goods, and you're thinking about four-wall retail as being a key driver for you, that tends to be the trend that we're seeing as brands look to scale into more channels. This is the gold standard that you'll be held against as far as gross margins, growth, durability, and scale, right? I think there's plenty of acquisition opportunities for brands that are sub this scale, but that continues to be the one. I think the other ones that are super interesting to take a look at or are indicative, I'll call out Carter's. Carter's has seen a really nice valuation improvement since we first started tracking this name. It's a little bit more of a kind of a sleepy older name with some brands that have been around for a while, but what they've been able to show is consistent earnings and consistent profitability over a long period of time, and they're continuing to improve that, and the market is rewarding that. So less sizzle, less reward for sizzle, and a little more reward for steak is kind of the core message over the last 6 or 12 months. I think another one to look at, and if you look at the trends here, two other outliers that I think are doing incredibly well are Yeti and Figs. And I think the reason for that is interesting. They're both not what you would necessarily consider fast-moving consumer goods that have high repeat purchase, but they are sort of these names that blend the right mix of trend and what's hot and a recurring purchase pattern. You could also throw Lulu into that, but both of them have relatively low. I wouldn't say low, but mid sort of price AOV products in the $100-ish range. But they're able to show consistent returning customer growth and be able to drive profitability because they're spending a lower portion of their dollars on total marketing. So that's definitely an interesting trend. Just to add a little bit of color from the private market data that we see, we have our customers represent about 35 brands that look like this across different sectors. these trends are definitely being felt in the lower middle market where we are and where Emmett operates as well. I think, the biggest push for us has just been a consistent theme and drumbeat of companies marching and striving to be more profitable. Across our portfolio, we saw median gross profits up actually almost 3 percentage points over the year. And that's really a focus of people, really getting tight on their cost of goods, getting tight on their variable costs, and trying to make sure that those gross margin dollars are there. And we also saw an uptick in net income. So, a slight downtick year over year in the portion, the growth factor, but our median growth in net income across the portfolio was 3.4 percentage points. The average growth across the portfolio was actually 4.8 percentage points. And then our top quartile of brands actually were able to improve net income by as much as 25%. So that was the top quartile difference. And so I think we're seeing that filter down, and it's an earnings-based world, and folks are starting to get the message, even at smaller scale, and pivot into that universe.
Awesome, thank you. You can tell that you've been tracking these stocks and valuations for several years. Great color and context. Thank you very much.
Yes, sir.
Keep the questions coming, folks, and we'll have time to get to them. Okay, so let's move to e-commerce M&A activity. I'll invite Lauren in a moment to give his thoughts, but I just wanted to share one slide to sort of give some context. Ever since the iOS changes in summer 2021, a lot of the investors in e-commerce have not been continually funding the space or the category. So you can see this data point that just came from Crunchbase last week. It shows that there's been a significant reduction in the number of rounds and the dollar value of rounds into e-commerce brands. So it's incredibly hard right now for e-commerce brands to raise equity. Let's be frank, which is leading a lot of folks to think about alternatives. Some folks have to do distressed exits. Others that are performing well that can't get equity either from their existing cap table or from new investors. Some of those are looking at either selling or thinking about different types of exit options. So, for example, it could be a two-step exit where you sell a portion now and a portion in the future. So you get sort of 2 bites at the apple. You don't give away all your value today. So I think that's important from a context perspective. Hopefully this will change again as the consumer gets stronger with more declining interest rates over the coming years, and we'll see more money coming back into our space. But something to keep in mind for the entrepreneurs on the call. So there are deals getting done, and we're delighted to sort of talk about those. So we invited Lauren to talk about 2 deals they've done in the last few months. Over to you, Lauren.
Hey, everybody. Thank you. Yeah, so we're pretty excited. To Emmett's point, I think we were one of the lucky ones that raised capital at the right time, and we're very cautious in how we deployed it in the early days. And that's allowing us to move very quickly now and find some really good brands to acquire. So a couple that we did in Q4. So Primal Life that you're seeing right now, really interesting backstory. So founder was noticing that all the products that she was consuming on a daily basis and giving to her kids had a lot of very poor ingredients, to say the least, between deodorant and toothpaste and sunscreen. And so she just started developing her own line of products at home with all natural ingredients, and started sharing it with her friends. People were very impressed with it, and she decided to build a company out of it. Company started growing very well. She found an underserviced niche in the all-natural dental product space, especially in teeth whitening. There's a lot of peroxides and very bad products in there. So she went out to make a whole line of dental products that were all natural that she was proud to give to her family and her kids. So they've grown the business. When we found them, it was a 8-figure revenue business, double-digit growth over prior year. They had a very strong margin. They actually had growth for 3 consecutive years. And what we really liked about them was the subscription side. So a very strong percentage of the revenue was on subscription, and the subscription average kept going up. So we ended up putting a deal together. We asked them So all of our deals are structured where we ask them to stay on for a minimum of 2 years, the founders, because we work alongside them to continue to build the brand. So we're really looking for founders that are passionate about the brands that they've produced, and see much further growth down the line, and feel that partnership with us allows them to get their brand out there into the market a lot faster. So we structured a deal where it combined cash at close. I won't get too much into the details, but cash at close with an earnout. We also offered some equity in Society Brands, and we offered rollover equity in their unit. So as their unit continues to grow and they continue to perform, that has more value. And as Emmett said, that gives them a second bite of the apple. We like to say that's the second bite of the apple, and then they get a third bite of the apple when Society Brand shares when we finally go public down the road. So that's Primal Life. I think there was one more slide, Emmett, on Primal Life. But anyway, the other one that we closed was called Club Early Bird. So also interesting backstory. Young entrepreneurial couple. They had started a number of different businesses, and they admittedly were not good in the morning. They just couldn't get up. They couldn't motivate themselves. And so they did a bunch of research around how do they optimize both their sleep and their morning routine so they could be more efficient. So they built this cocktail, as they call it, of vitamins and minerals and hydration. And it took off. They started building a community. Community is super passionate about the products that they're putting together. They do flavor drops every 6 weeks. And we really like the brand, not only because of how quickly it was growing, but how passionate the follower base was, and the subscription base. So they have a VIP program that people wait to get on, so they could be the first one to find out about the new flavor drops. And the group does, they trade flavors in their Facebook group. It's a pretty interesting business. So very similar kind of structure. We looked at cash at close. We also offered an earnout, also with rolled equity within their own units, and an equity in Society Brands. We just find it creates just a tremendous amount of alignment between both the sellers and us, and so everybody's working in the same direction to push the brand to the next level. And the more the better the brand does, the better we all do. So yeah, those were the 2 deals we closed in Q4. And as Emmett said, we're absolutely in acquisition mode right now. We've got 4 more deals we're closing in Q1 already lined up. We're mapping out our Q2 and beyond right now. And really what we're looking for is interesting products, strong growth, strong subscription. But as important to us is really great founders, because we're going to be working with those founders for 2 years. No one wants to get up every day and work with people they don't like. So we spend a lot of time, even before an LOI, getting to know the founder, building that rapport, and making sure it's a good fit. So that's a little bit about our acquisitions in Q4.
Thank you, Laurent. It's great to see an acquirer being so open about the deals that they're doing. Thank you for that.
No problem.
Excellent. And there's questions coming in which look really interesting. We'll come back to those shortly. Okay, so brand metrics. There's a slide. This is probably one of the most fascinating slides presented at our conference last week. It was presented by UBS, and we've sort of asked for their permission to recreate it here today. It looks like quite a complicated slide, but actually it's really quite simple. And when you boil it down, basically what it's saying is, in pre-correction, before the markets turned, the market was valuing growth above everything else. You can see that in the light blue line. Growth stocks, growth brands were getting a better return. They're getting higher values. That changed around the correction. So you can see that the light blue line has decreased quite significantly about 6 months ago. And the darker line has increased. So people are, it's looking at the bottom line, frankly, more than the top line. Although you can see that growth has come a little bit back into focus. So what does this mean for the entrepreneurs, the e-commerce entrepreneurs on the call? It means acquirers and the market, acquirers, investors, i.e. the market right now, is still prioritizing the bottom line over the top line. So if you're thinking about coming to market, focusing on your net margins is really key. Cash is king in a difficult market. It's not growth at all costs. I think that's important in when we talk about this section, brand metrics, because a lot of those are inside your control. The markets are not inside your control. Interest rates, unfortunately, we can't control those. But as you think about optimizing your brand and measuring your KPIs, what you're sort of trying to align to, stick to the bottom line type focus for the moment. That may change in the coming years, but not in 2024 in my view. We need to see interest rates come down significantly for a major change. To dive deeper into brand metrics for FBA-led entrepreneurs, excuse me, we have an 80-page exit guide for you, which is freely available via the website, and we have something similar for DTC-led brands. Both of those documents were co-authored with at least 20 acquirers, so it's not just our view, it's all our IP and the views of actual deal makers. So please download those at your leisure and take on board a lot of the free nuggets of advice. Okay, you can do all the planning, you can think about the markets, you can have your brand optimized, but ultimately then a portion of the valuation will come down to actual deal dynamics. What do we mean by that? Well, there's several components. There's the shareholder situation. Is the shareholder under pressure to sell? Is it a distressed situation? Has someone got ill? There's a lot of different factors that can impact the urgency of whether a shareholder needs to sell quickly, which can impact valuation. The acquirer situation, I'll go through a slide on that in a moment. Retaining good advisors can have a big impact. Marketing distribution, make sure you go as wide as possible. You're thoughtful in the targets you're approaching. The bigger you get, the more you've earned the right to go to lots of different types of institutional targets, whether they're corporates, private equity, or aggregators. The synergies, especially for strategics and other forms of buyers, it's really important to understand, what's in it for them. What are their synergies, both on the revenue and cost side? You need to put yourself in the shoes of the buyer. And deal structure, obviously that can impact it. Do you want more upfront, which might mean a lower multiple, but you might see more security you're getting the cash in the bank. So just to jump into two of these very briefly, from an acquire situation perspective, on our last webinars, we've had charts showing that there's an incredible amount of dry powder at the availability of private equity firms, i.e. they have so much money to put to work sitting on the sidelines. It's actually quite frustrating that they're not putting more of it to work. And I think the people that give the private equity firms are also getting frustrated because they're sitting on a lot of money and not putting it to work. So I hope that in 2024, as interest rates come down, a lot of this money will be put to work in all sectors, including our sector, the e-commerce space. And that this chart will start to rebound. We'll start to see more deal flow. This clearly relates more to bigger e-commerce brands. Private equity do two types of deals: platform and bolt-on. Platform is at least tens of millions of revenue type brands, but bolt-ons can be much smaller. So it does apply to lots of folks on the call. Something to think about. Again, you need to go wide from a distribution perspective and go wide that's sensible to your brand. But please keep in mind, that you can sell to aggregators, private equity, or strategics, depending on the specifics of your brand and its performance. I would say this, but retaining advisors, again, I'm ex-Morgan Stanley. We're trying to create a Wall Street type level of offering to small mid-cap e-commerce folks. This study analyzed over 3,000 deals and showed that where you have a strong advisor, you can get up to 25%. We're not a broker. We're not a listing website. We're a full service investment bank. We're looking to do a small number of intense advisory projects each year where we get the best deal for our clients. So please reach out if you'd like to discuss any of your projects or plan towards an exit. Okay, so ultimately, all these 6 sections that we've done walked through already on the webinar, all roads lead to valuation. So few slides from us here today, and then we'll open up a Q&A. We did 2 polls at our conference last week where we asked acquirers in the room what valuations they were seeing for profitable FBA-led brands. We'll talk about DTC brands in a second. I want to emphasize that these are for profitable brands, not distressed brands. And you can see that the range is very wide, which is unhelpful. I mean, it's going down to 1x for profitable brands to me doesn't make any sense. No entrepreneur that has a profitable brand will sell for 1x. But also 8x doesn't make any sense. If you saw, Austin talk about the median of listed stocks being in the sort of 7 range, then a very small e-commerce FBA brand isn't going to trade for 8x. And 7x is probably the highest multiple we've heard of for an FBA-led brand back in the good days of December 2021. There's such a wide range, though, that it's important that if you do go to market, you're approaching all of the relevant buyers, ideally those that are giving fair prices. And we, as an investment bank in the space, have insight into that. That was FBA. Let's switch to DTC. DTC brands have higher multiples because they have owned their customers is the key reason. Again, the range is very wide, going from as low as 2x all the way up to 12x. Clearly, again, these are for profitable brands, not distressed brands. In our view, 2x for a profitable DTC brand is not fair to the entrepreneur that's created that. And on the flip side, to get to 12x, it would have to be a diamond, and we'll describe what we mean by that in a moment. So diamonds, we as a business are looking for diamonds all the time to work with the best entrepreneurs in the world to bring their brands to market. What do we mean by diamonds? Well, we mean a brand in an in-demand category, and this changes. Maritz's data is the best data in my view to know which categories are of most interest to consumers in real time, effectively. Right now, examples of favorable categories are pets, baby, beauty. Significant quantum of revenue. So the more revenue you have, generally, the higher valuation you can get. So I'm talking about the differences between 5, 10, 20, 30 million. High revenue growth. We only work with brands that have growing revenue. Otherwise, frankly, right now, it's quite difficult to get a deal away. Recurring revenue is massive. If it's a subscription business, a DTC subscription business, you can get a significant multiple on EBITDA and a good multiple on revenue. Net margin for FBA, want to see at least 20%, for DTC 15% with a great trajectory. And then, every acquirer wants a proper brand with a capital B, ideally with some defensibility, patents, and so on, and an omni-channel opportunity. So this is the sort of the perfect diamond, so to speak. The reward for these diamonds is up to potentially 6x on the FBA side if it's a competitive auction, and on the DTC side can be above 10. There are deals in the pet space getting way above 10, even now. So let's bring it all together as we do every quarter. Where are we today? Where have we come from? So look, valuations have stabilized since the highs of Q4 2021, with December that year being the highest in our view. We expect, as we go into 2024, reduced interest rates to increase the likelihood of deals getting done. But that doesn't necessarily mean immediately increasing the valuations. But increasing the likelihood of deals getting done, believe me, is a major step forward for all of us, both sides of the deal. So we will see more volume, which is great. We think valuation increases probably won't come in the first half of this year, but may do in H2 after we've seen a reduction in interest rates. So for FBA-led brands, we're sticking to our Q4 valuation range. It's 2x to 6x. Yes, it's quite wide. Most deals are getting done in sort of the 2.5 to 4.5x. Again, to emphasize, anything above 4.5x to 6x, that's a diamond. And they are very, very much the exception rather than the rule. To be clear, these multiples include upfront components and deferred components of revenue. The deferred components could be earnouts based on revenue or EBITDA, and they're not always met. So if you get a sticker price of 6x, it doesn't mean you'll ultimately get 6x. On the DTC-led brands, we've changed it slightly since our last quarter. We've increased the bottom amount. Again, these are for profitable DTC brands. We feel it's fair that they trade a little bit higher than FBA counterparts because they own the customer. And yes, there's some distressed brands being priced at below 3x, but for a profitable DTC brand, if I owned it, I wouldn't be selling for anywhere below 3. I'd be looking for much higher. The last DTC deal we priced was 7.1x as an example. Okay, we have 13 minutes for audience Q&A. Can I ask all the panelists to turn on their videos again, and we will begin questions. Okay, so the first question, going back to valuations, Laurent, they're asking, is it forward-looking or last 12 months, the multiples that you were showing?
Yeah, all of the multiples that we publish are based on trailing 12, so they're backward-looking.
Yeah. Could you talk about how 8x revenue was justified here? What was the percentage of recurring revenue? That's a link. Let's come back to that. I need to open up a link first. Question to Laurent. How is the equity role structured? Do they have a clear exit horizon, multiples, etc.?
They do, yeah. We want to make sure the seller completely understands what they do with the rolled equity and the timing of it. So typically, there's a time frame before they can decide to sell their equity. They're not obligated to at the start of that time frame. It's any time after that. And we define and negotiate the multiple based on EBITDA ahead of time, right into the contract up front.
Very good. Question for you, Moritz. As we look forward to interest rates coming down, what categories do you think will see the most positive rebound or positive impact?
So as said prior, as we see interest rates coming down, we see a lot more movement of consumers to larger purchases. So generally, all the areas with high price points, consumer electronics, TVs, and then also by extension, any accessories or any necessary expenditures that come with bigger purchases, such as a home. So we think we will see increased spending in home and garden, increased spending in accessories, in accessories across cars, which we've also seen come down. This is how we think about the market and where we see growth.
Great, thank you. Austin, would it be possible do you think, over time to add some smaller e-commerce companies to your index, or maybe have a separate index?
Yeah, we have a couple in there that are relatively small. The challenge is getting the same quality of data for smaller companies, but if there are publicly listed and we have the same quality of data, happy to add them. We also plan to start publishing more from our internal data set, from our companies, and more anonymized metrics. We're sort of doing that in blog posts and one-offs. But yeah, I'm very keen to. We've started using them internally inside of our software tool, so that companies can benchmark themselves against both public and private market comps on metrics, including the ones that you saw, as well as a number of other ones that are more specific to things like customer lifetime value and unit economics. So that's something that I expect will come online for us over the course of 2024 and certainly ongoing.
Great. There was a question: how long does a typical sales process take? I'm happy to take that one. The first question I'd ask back is it going to be structured as an asset purchase agreement or a share purchase agreement? If it's an asset purchase agreement, it can be 3 months. Typically, if it's a share purchase agreement, it's a longer deal time, typically up to 6 months. So the range is 3 to 6 months. Gone are the days when people would give out LOIs within 5 days and try and complete deals within 30 days. On the FBA side, that was, looking back, frankly, crazy. So, take your time. I think the biggest mistake most entrepreneurs make is they don't start planning far enough out for their exits. If you're an S&P 500 company, you're thinking 1 to 2 years out. So please gear up, get yourselves exit ready, and take your time and go through a professional, thoughtful process that ultimately gets you the right result rather than trying to rush a deal. Lauren, can you say anything about your firepower for 24?
Sure, yeah. So we, when we raised about a year ago, between borrowing capabilities and equity, we had about 250 million. We have about 170 million left. Our goal is to acquire at least one brand a month for the next 12 months. That's our goal for 2024. We're off to a good start. It's all about pipeline. We're not going to rush it. At the end of the day, it's about high quality right now. The land grab days are gone, and we're just going to make sure that it's the right deals. And if we have to slow down because we can't find them, we'll slow down. But we've got the firepower right now.
Thank you. One of the questions was linked to a Bloomberg article, which is all about CVC agreeing $800 million to buy Sunday Natural for 8x revenue. We've been asked, how is that multiple justified? I would need to do more homework on that to sort of take a look. Obviously, 8x is incredibly punchy. Any of the panelists looked into that yet, or shall we take that offline with Alexei?
I don't know that deal specifically, but what I can say is that on both certainly on the equity investment side and on the acquirer side, supplements have been a category that is very hot and doing very well in our portfolio and among the best. It typically lends itself extremely well to a subscription business model. So I would guess that there's a fairly high quantity of recurring revenue. And often there are supplier relationships where there may be proprietary ingredients or something like that, where there can be at least the idea of unique IP for those brands, and the idea that, okay, using some sort of technology, we could spin off into other use cases or into other brand names. So typically when I see a valuation like that, my guess is that there's at least the promise of some additional brand expansion as part of the deal, especially in the supplements, nutraceuticals space.
Yeah, agreed. I mean, your thoughts on recurring revenue is absolutely spot on. There must be a big element of recurring subscription.
Jörg, the founder, is actually a friend of mine from Berlin.
Oh.
And while I can't comment on sort of the percentage of recurring revenue, he's a former CFO of Axel Springer, and I think he also knew very well how to sort of play the corporate game and how to present the company financially.
Clearly, he's done a great job, and congrats to him. A question: for a smaller 5 to 10 million e-com company, mix of DTC and FBA, how far out should exit planning begin? So let's just say a process takes 3 to 6 months. I would be at least adding that period of time before you actually start the process. In terms of getting your ducks in a row with your accountants, you're on the legal side, working with a firm like us to that we do something like an audit report. We can be 1 to 2 years out, where we look under the hood of your entire business and give you our view as the things you can change over a 1 to 2 year view to enhance your business for an exit. So again, the best companies in the world, like Elon Musk, will think about an exit 1 to 2 years out, maybe longer. Please don't start an exit process, with only a month's notice. Does Fortia work with brands who don't want to fully sell to find investors for less than 50% ownership equity? Yes, look, we help brands think about raising equity, credit, and ultimately a full exit. Frankly, equity is really, really, really tough right now for you remember the Crunchbase chart I showed you earlier on. So in some cases, you might be able to have a 2-step exit to strategics. Our aggregators are private equity, so happy to discuss. Please reach out to myself or one of the team. Okay, we have a few minutes left. Maybe to finish, gents, is there any sort of call out or key point you'd like to finish with, or prediction for the coming quarter or half year? Who'd like to start?
I hope and think we're in for better times. So
we see consumers shifting, interest rates coming down. I feel there's a little more excitement. I hope it translates into the space specifically, but the economy overall.
Here. Agreed.
I'll say I agree. I think there's going to be more money flowing in. I also think it's going to continue to be very competitive for brands. That's not going to slow down. I think the cost of marketing isn't going to slow down. So while more money will flow in, I think it's just going to keep being difficult to grow brands unless there's a very unique proposition and patents and other things that protect it from competitors.
Agreed. And Austin, to finish.
Yeah, I think, I'm very, very eager. I think as soon as we get that first Fed rate cut, I think we'll see some of these IPOs that have been waiting on the sidelines come out, and we'll get an interesting look at where the public markets are valuing some of these consumer brands and what's happened. I think specifically in the apparel space, there's a bunch that have been hanging out, and we'll see if apparel still continues to be kind of a dog in the industry, or if people are interested in acquiring those brands. And then I would say from a company perspective, the number one thing that we're counseling our founders on is continuing to steadily improve the durability of both their revenue and their profitability. And to the question around, how long does it take for an exit or to prepare, I would say, generally, I would guess that if they're going to speak to you, Emmett, or they're going to start speaking with acquirers, there's going to be things about the business that they're going to want to change. And it's very difficult to change anything about the business over a period of less than about a year, right? So having those initial conversations or starting to understand what good looks like and then chart the course to getting there over 12 or 18 months, I think is probably, the right time frame. And despite how realistic most founders, I think, are, they're often kind of still a little bit shocked when they're like, I've worked so hard in this business and this is still not good enough. So I guess it's the idea that you can always be better, and charting the path to getting there, I think, is really important over a 1 to 2 year period at minimum.
Yeah, and I think a fresh, independent view. Sometimes entrepreneurs and the C-suite can be, stuck inside their world. I think getting fresh perspectives and independent views on what one could change is important. And as you're right, it takes time. Meaningful change takes time. Excellent. We have 1 minute to go, so I'd just like to finish by thanking you all for speaking. Maritz, Austin, Lauren, thank you for squeezing us in from your car. Appreciate your time. Please reach out to myself or any of the panelists if you'd like to follow up with any questions. Otherwise, wish you a great day. Thank you.
Thanks, Emmett.